You wish to understand trendline liquidity. Good. Most men draw lines. Very few understand what those lines represent. Fewer still understand why price so often pierces them with precision, as if guided by an unseen hand, only to reverse and leave the latecomer wounded and confused. A trend line is not a line. It is an agreement. It is a visible record of behavior. It marks where the public believes value resides and where they believe safety exists. When price respects a rising line again and again, traders grow confident. They buy the touch. They place their stops just beneath it. They tell themselves the trend is intact. That confidence is liquidity. The market does not move because lines are drawn. It moves because orders are placed. Every stop loss is an order. Every breakout entry is an order. These orders collect around obvious places. Trend lines are obvious places. The inexperienced trader sees structure. The professional sees inventory. Consider a rising market. Higher highs, higher lows, a clean ascending trend line connecting each reaction. The crowd admires it. They share charts. They speak of strength. With each touch of the line, more traders enter long positions. They place protective stops just under the line, perhaps a few points below the most recent swing low. It feels prudent. It feels disciplined. Yet beneath that line sits a pool of sell orders, stop losses from longs, stop entries from breakout traders waiting for a breakdown, liquidation orders from those on margin, all clustered, all waiting. Price is drawn to liquidity the way a magnet is drawn to iron. The market requires fuel to move. Large operators cannot buy or sell size without counterparties. Liquidity provides those counterparties. When you see price sharply break a well-respected trend line, do not think first of failure, think of fuel. Think of orders being triggered in succession, cascading into the hands of those prepared to absorb them. If you buy every touch of a trend line, you will eventually finance someone else's campaign. The lesson is not that trend lines are useless, far from it. They are maps. But a map is only useful if you understand the terrain. Ask yourself at each approach to a trend line, who is committed here? Who is trapped here? Where are their stops? What narrative is being sold to the crowd? Markets do not punish randomly. They punish predictability. I recall periods when a stock would advance steadily, obedient to its upward line, each reaction shallow, each rally decisive. The newspapers would speak of strength, analysts would upgrade. Volume would swell at the highs. Yet as the line became more obvious, as it appeared on every clerk's chart, I would grow cautious, not because the trend was weak, but because the trade was crowded. When a trade becomes obvious, liquidity accumulates beneath its foundation. Understand the difference between a genuine reversal and a liquidity sweep. A genuine reversal is born of imbalance. Supply overwhelms demand over time. Rallies become labored. Highs fail to extend meaningfully. Distribution appears in the tape. A liquidity sweep, however, is swift. It is surgical. Price dips beneath the trend line, triggers stops, invites aggressive sellers, then reclaims the structure as though nothing occurred. The crowd calls it manipulation. The professional calls it opportunity. You must train your eye to see the character of the break. Was there expansion in volume? Did the market immediately find eager buyers at lower prices? Did the broader structure remain intact? Or did the breakdown accelerate, forming lower highs and lower lows with persistence? A line break is not a signal, it is an event. The interpretation of that event determines profit or loss. Most traders anchor their decisions to geometry. They believe the angle of a line predicts strength. It does not. What predicts strength is participation. If a trend line has been respected multiple times, you can assume orders are layered beneath it. The more times it is touched, the more traders commit capital there. With each commitment comes a stop. Liquidity builds like water behind a dam. When the dam is breached, the flow can be violent. That violence can serve two purposes. It can initiate a true change in trend, or it can provide the final shakeout before continuation. The distinction lies in context. Context is the backbone of speculation. Where is price in relation to the larger structure? Is the trend mature, extended far from its base, or is it early, supported by accumulation? Are fundamentals aligning with continued movement, or is sentiment euphoric and fragile? A late-stage trendline break carries different weight than one occurring after a shallow correction in a young trend. Do not treat all lines equally. Trendline liquidity is most potent when the line is clean and obvious. The more beautiful the pattern, the more dangerous the location. Beauty attracts participation. Participation creates liquidity. Liquidity invites exploitation. I have observed traders who pride themselves on drawing precise lines. They adjust them to fit every pivot. They feel in control. Yet control in this business is an illusion. What matters is anticipation of behavior. Instead of asking, will the trend line hold? Ask, if it breaks, what chain reaction will occur? Imagine the market as a battlefield. The trend line is the visible front. Behind it stand ranks of soldiers with stop orders. Beneath it, opposing forces wait to strike. When the line is breached, stops become market orders. Market orders create urgency. Urgency creates slippage. In that moment, those who prepared to absorb the flow gain advantage. You must decide whether you wish to be among the prepared or among the triggered. A common mistake is entering short immediately upon a break of an ascending trend line, believing a new downtrend has begun. Often, that entry provides liquidity for larger buyers. They allow the break, even encourage it, because it enables them to accumulate at discounted prices. Once sufficient inventory is secured, price is lifted sharply, forcing the fresh shorts to cover. The move back above the trend line becomes explosive. This is not magic. It is mechanics. Liquidity rests where emotions cluster. Fear places stops. Greed places breakout orders. Hope delays exits. All three gather around structural levels. Do not mistake a trend line for support or resistance in the abstract. It is simply a visible reference point around which human behavior organizes. When trading near a trend line, consider scaling rather than committing entirely at one price. Consider waiting for confirmation rather than predicting. Consider allowing the market to reveal whether the break is genuine or merely a sweep. Patience is capital preserved. Another subtlety lies in the slope of the line. Steeper lines suggest urgency. Urgency is rarely sustainable. A parabolic ascent builds fragile liquidity beneath it. When such a line breaks, the cascade can be severe because late buyers entered aggressively and placed tight stops. The more emotional the ascent, the more violent the potential sweep. Gradual trends, by contrast, distribute liquidity more evenly. Breaks of such lines may be less dramatic but more decisive. Study the tape around these levels. Does price accelerate into the trend line with heavy volume? That may indicate a liquidity hunt. Does it drift slowly and then slice through with conviction? That may suggest genuine supply entering. You cannot rely on the line alone. You must observe behavior. There were times when I anticipated a break, not to join the breakdown but to fade it. I would wait for the line to give way, watch the panic unfold, and then gauge the response. If buyers absorbed the selling swiftly, if price reclaimed lost ground with authority, I would align with the larger trend. The false break would have removed weak holders, clearing the path for continuation. Weak holders are an impediment to sustained movement. Liquidity events remove them, but take care. Not every break is false. Pride has cost many traders dearly. If a trend line break is accompanied by structural deterioration, lower highs forming quickly, rallies failing beneath the broken line, volume expanding on declines, respect it. The market is shifting. Liquidity has not merely been swept. It has been converted into sustained supply. Discipline demands flexibility. You must detach from your drawings. The market owes no allegiance to your analysis. Lines are tools, not truths. Trendline liquidity becomes even more powerful when aligned with higher time frame levels. If an ascending line on the daily chart intersects with horizontal support from prior months, the concentration of stops intensifies. A break there can unleash substantial movement because multiple groups are affected simultaneously. Think in layers. Intraday traders, Swing traders, position traders, all anchor to visible structure. Where their levels overlap, liquidity multiplies. Never forget that large interests operate with size that requires planning. They cannot enter quietly in illiquid pockets. They require zones of heavy order flow. Obvious trend lines provide such zones. Therefore, when you see price approach a well-defined line, do not rush. Observe. Let others act first. Their actions will reveal intent. The greatest advantage in speculation is not speed, it is clarity. If you learn to see trend lines not as barriers but as reservoirs of orders, you will begin to anticipate rather than react. You will expect volatility at those points. You will reduce position size before engagement. You will avoid placing stops precisely where the crowd does. You will think in probabilities rather than certainties. Remember this: the market's primary function is to facilitate trade. To do so, it must access liquidity. Trend lines, by their very visibility, advertise where that liquidity resides. When next you draw a line beneath a rising market, do not congratulate yourself on having identified support. Instead, ask yourself how many others have drawn the same line. Ask where their stops lie. Ask who benefits from triggering them. In that inquiry lies the beginning of understanding. This business rewards those who think one step beyond the obvious. If the obvious trade is to buy the touch, then consider what happens when that touch fails. If the obvious trade is to sell the break, consider who profits from that urgency. Your task is not to predict the future. It is to position yourself where the imbalance will likely occur after liquidity has been harvested. Trendline liquidity is not a theory. It is the natural consequence of human behavior clustering around visible structure. Master that behavior, and you will cease to be surprised by sharp breaks and swift reversals. You will begin to expect them. And when you expect them, you can prepare for them. I will pause here. When you are ready, tell me to continue, and we shall examine how to trade these events with precision and restraint, so that you are no longer the one providing liquidity, but the one using it.